in the context of private and public equity placement, how do you source those opportunities, especially in developing countries? And two, with not very robust public markets there, what kind of exit opportunities do you see? Is it to other financial sponsors? Is it to strategic buyers? How do you actually realize the investment? Thank you.
For the work in the developing world, I think for us, step one is be very mindful of what we can do from San Francisco and New York. So step one for us, for our developing world clients, is we get invested in great fund managers on the ground in those countries and in those sectors where they want to play. So let's not go out and we're going to try to pick the best small ag investment in India. Let's be invested in a great fund manager that can help us when the time comes. If we actually want to go to that point, we may just want to stop at the fund manager. The point about exits is a good challenge. I think we see a lot of folks adapting. So deal structures are tending to have more self-liquidating options where there's a chance for management to buy the company back over time, or other ways where they're doing kind of a form of debt as opposed to equity. The exit nut in these markets is a tough one to crack, but people are steadily working. There's also an interesting effort underway to try to create a permanent capital vehicle, basically a pool of capital that can just buy and hold these stakes over time. That's not tied to a fixed life for a venture fund. That's like, okay, I got to invest, I got to get in, and I got to get out in a timely basis in markets with crappy exit opportunities. And so to try to transcend that, to look at other fund structures that may ameliorate that a bit.
I can speak a little bit because most of the work I've done is on the exit side has been in the microfinance community, and everybody talks about some of the big IPOs, Coportamos in Mexico, SKS in India, but most of the exits have been a combination of either strategic sales with large, and so in the case of microfinance institutions, large banks in many of these countries that see the financial opportunity and buy one of these institutions, one or more, as a way to get access to that market. Or two, as to John's point, we've seen a lot of non-traditional exits, and one of the ways that I look at it is if you own a company in the developing world and that company has an attractive cash-on-cash return, you will find that you have optionality with respect to an exit, because the return that that company is delivering gives an opportunity for a new buyer to finance it, for you to finance it for the buyer, for someone else to come in. There's just a variety of different things I've seen cobbled together that enable you to get what isn't the same exit as if you own Facebook stock here in the US, but can be an attractive exit nonetheless.